All right, remember I just mentioned that we got buckets, right? So let me explain this in detail. So basically, there are two buckets of carryover, and one is the QBI components. So basically, that's your share of the income or loss, unfortunately, from the regular path through trade or business. And of course, there are two exceptions, which is REIT and PTP. PTP stand for Public Traded Partnership. Okay, and from the practice perspective, a lot of my clients invest in REITs. So if your share of income from the REITs stand for Real Estate Investment Trust. So basically, it's a kind of an investment type vehicle. It's not an active trade or business that you actually run yourself, but rather you invest in that investment type vehicle, and then you invest in, say, come on, rates is like real estate market, right? But it's a standardized vehicle and that they can buy and sell. You don't need to actually like buy a certain house. It's like rates is like investing in a lot of houses, but that's more about investments. Okay, let's focus on the tax part. Okay, so basically there are three different sources like QBIs, components, carryover, rates, and PTPs. So if it's the QBI component carryover, that your share of income or loss from the regular pass-through trade or business, so for example, sole proprietorship, as I mentioned before, the partnerships, the S corp, the LLCs, right? As long as it's passing over, you typically reporting in Schedule C, E, or K1. Okay, and if, as I said, the big exception here, if your share of the income come from rates or PTPs, that's completely different. So think of this way. I know this may seem a little bit complex. If you already invest in rates and PTPs, I strongly recommend that you hire some professional to do this, because it can get a little bit complex because it's not a mix up with the regular QBIs components. So say you invest in rates or PTPs, okay? This amount is qualified for the QBIs deductions is separate. So for example, if you invest in rates or PTPs and then you got like say some PTPs lost money, lose money this year. Okay, so if you got a net loss, that net loss does not mix up with your regular QBIs. Okay, for example, if you own your business and you earn some money, and you also invest that money into like separate business or rates. Okay, and then that rates and PTP lose money, and say your business earn money or lose money as well. Unfortunately, if you do that scenario, these two, the regular QBI as well as the QBI from the rates and PTPs, do not mix up. Okay, and instead that rates and PTPs become its own rates and PTPs carryover, and it track differently. So basically, it's like Form 8995 and Form 8995A Part 2, something like that, right? And as I said, it's really complex. So basically, you got a separate series of form to track that specific carryover, okay? And do not affect your own QBI, because if you think about this, you do reflect some of the legislation spirit, because the IRS doesn't want you to like cross offset between these two, because your business QBI component cannot like reduce your rates or PTP's deduction, and PTP and rates deduction cannot reduce your own business the QBI deductions. Each got tracked separately, and if you think about it, your own QBI means you actively run business. Like active business losses don't just distort the passive investment, right? Rates and PTPs is like investments. You are work as investor. You invest in some financial products. It's the standardized investment vehicle that you do in order to get that money. But that's passive, right? You're not actively say, hey, I want to buy this house, real estate, right? I want to rent this house, I want to sell this house, right? Rates is constantly got the manager to do that. So basically, the spirit, the legislation spirit of the IRS say, hey, this is like passive income, right? And if you like win or lose in this investments, you don't want this like these two types of mix up, because for rich people, it might like combine this together to using one type to boost another deduction, right? And that's just an unfair advantage. So IRS say, hey, it's a separate. Your business, your active wrong and operating business, and your passive investments is separated. We're going to track that separately. Okay, so you can sort of see why it's got like two buckets and three different sources of carryovers. And yeah, basically that's it. Once you understand the spirit, the legislation spirit, it becomes really easy. And for you, if you don't hire someone, you just need to know that you need to treat that separately. You can't like mix them up.